With interest rates expected to decrease over the next 6 months, many homeowners are planning to refinance their higher interest rate mortgages. However, with a lot of those homeowners being first-time buyers, they're unsure of where to begin. What's up, everyone? Brand the Mortgage Man here, and I've helped more than 10,000 home buyers over my 22-year career, putting me in the top 1% of loan originators nationwide. In this video, I will explain what refinancing is, when it makes sense, popular factors to consider when refinancing, and the steps you should take to start the refinance process. So let's get into it. So what is a refinance? Well, a mortgage refinance is the process of replacing an existing mortgage with a new one, typically to secure better loan terms or adjust the mortgage conditions to better fit a borrower's current financial situation. The process involves taking out a new loan to pay off the old one, and it can potentially lead to a lower interest rate, reduce monthly payments, or a change in the loan's duration. Homeowners often refinance to save money over the life of the loan or to modify their payment structure according to their financial goals. There are two primary types of mortgage refinances: rate and term refinances and cash out refinances. A rate and term refinance focuses on changing the interest rate and or term length of the mortgage. For example, a borrower might refinance to secure a lower interest rate, which could lower monthly payments and reduce the total interest paid over the life of the loan. On the other hand, a cash-out refinance involves taking out a new mortgage for more than the amount owed on the existing one, allowing the borrower to receive the difference in cash. This type of refinance can be useful for accessing funds for home improvements, debt consolidation, or other financial needs, but it generally results in a higher loan balance and may come with a higher monthly payment. So why do people refinance? Well, people often refinance their mortgage primarily to take advantage of lower interest rates. When interest rates drop, refinancing allows homeowners to replace their existing mortgage with a new one at a reduced rate. This can lead to substantial savings over the life of the loan, as a lower rate decreases the amount of interest paid each month. By securing a new loan with a lower interest rate, homeowners can significantly reduce their monthly payments and overall interest expenses, making it a financially beneficial move. Another common reason for refinancing is to adjust the terms of the mortgage. Homeowners may choose to refinance to either shorten the loan term or extend it based on their current financial needs. Shortening the term can lead to paying off the mortgage more quickly and saving on total interest costs, while extending the term can lower monthly payments and provide more breathing room in the household budget. This flexibility allows homeowners to tailor their mortgage to better align with their long-term financial goals and current financial situation. Refinancing also provides an opportunity to access home equity through a cash-out refinance. This involves taking out a new mortgage for more than the amount owed on the current loan and receiving the difference in cash. Homeowners can use these funds for various purposes, such as renovating the home, consolidating high-interest debt, or funding major expenses. While accessing home equity can offer immediate financial benefits, it also increases the mortgage balance and may extend the repayment term, which requires careful consideration of long-term financial impacts. So when does refinancing make financial sense? Refinancing makes financial sense when it offers a tangible benefit that outweighs the associated costs. This is typically the case when a homeowner can secure a significantly lower interest rate than that of their current mortgage, leading to reduced monthly payments and overall interest savings. It also makes sense if the homeowner wants to adjust the loan term to better fit their financial goals, such as shortening the term to pay off their mortgage faster or extending it to lower monthly payments. Additionally, refinancing can be advantageous if it allows access to home equity for meaningful uses, like home improvements, consolidating high-interest debt, as long as the new loan terms remain favorable and the costs of refinance are justified by the benefit. So what's an interest rate reduction? Well, a rate reduction refinance is a specific type of mortgage refinance focused on securing a lower interest rate for an existing mortgage. The process involves replacing the current loan with a new one that has a reduced interest rate, which can lead to lower monthly payments and a decrease in the total amount of interest paid over the life of the loan. The primary benefit of this type of refinance is the opportunity to capitalize on favorable market conditions, such as drop in interest rates, which can result in substantial savings for the homeowner. When the interest rates fall, refinancing to a lower rate allows homeowners to reduce their monthly mortgage payments, freeing up funds for other uses or improving their overall budget. Over time, the savings from a lower interest rate accumulate, leading to significant reductions in the total interest expense paid over the duration of the loan. For example, A 1% decrease in the interest rate on a substantial mortgage can translate into thousands of dollars in savings, demonstrating how even a small reduction in rates can have a substantial financial impact over the long term. Let's talk about shortening the loan term, another reason someone refinanced. And refinancing a mortgage to a shorter term can be highly beneficial for homeowners aiming to save on interest payments and pay off their loan faster. By choosing a shorter term, such as a 15 or 20 year instead of a standard 30-year mortgage, borrowers can take advantage of lower interest rates typically associated with shorter terms. This results in significant interest savings over the life of the loan, as the principal is paid off more quickly and the total interest accrued is considerably less. For instance, a 15-year mortgage often comes with a lower interest rate compared to that of a 30-year mortgage, which can lead to thousands of dollars in savings over the duration of the loan. However, the trade-off for these interest savings is an increase in the monthly payment. Because the loan is paid off in a shorter period, monthly payments are higher compared to longer-term mortgage. While this can strain the monthly budget, the overall reduction in interest paid and the benefit of becoming debt-free sooner can outweigh the higher monthly costs for many homeowners. This approach is especially advantageous for those with stable finances and a desire to accelerate their mortgage payoff, ultimately leading to financial freedom and reduced long-term costs. Another reason why people might refinance is switching loan type. Refinancing a mortgage from an adjustable rate to a fixed rate loan can offer significant benefits, especially in a rising interest rate environment. Adjustable rate mortgages, or ARMs, often come with lower initial rates that can fluctuate over time, leading to uncertainty and potential increases in monthly payments. By refinancing into a fixed rate mortgage, homeowners can lock in a stable interest rate for the entire term of the loan, providing predictable monthly payments and protection against future rate increases. This stability can be especially valuable for budgeting and long-term financial planning, as it eliminates the risk of payment hikes associated with ARMs. Some people might even switch from an FHA loan to a conventional mortgage, which can also be advantageous for many borrowers. FHA loans, while accessible with lower down payment requirements and more lenient credit standards, often come with higher mortgage insurance premiums, which can increase the overall cost of the loan. By refinancing into a conventional mortgage, borrowers with sufficient equity and good credit can eliminate private mortgage insurance if they meet the required down payment threshold, leading to lower monthly payments and overall loan costs. Additionally, conventional loans may offer better interest rates for borrowers with stronger credit profiles, further enhancing the financial benefits of refinancing. A big reason why someone might refinance is to gain access to their home's equity. A cash-out refinance allows homeowners to access the equity they've built up in their home by taking out a new mortgage for more than the amount owed on the existing one. The difference between the new loan amount and the remaining balance on the old mortgage is given to the homeowner as cash. This can be a strategic financial move if they need funds for significant expenses or investments. The new mortgage typically has a higher balance than the original loan, but it offers the benefit of unlocking home equity for immediate use. The cash obtained through a cash-out refinance can be used for a variety of purposes. Many homeowners use it to fund home improvements or renovations, which can increase the property's value and enhance living conditions. Others might use the funds to consolidate high-interest debt, such as credit card balances, into a single lower-interest mortgage, thereby reducing overall debt payments and improving financial stability. Additionally, the equity can be used for major expenses like educational costs, medical bills, or investment opportunities. However, it's important to consider that while this option provides access to immediate funds, it also increases the mortgage balance and may extend the repayment term, which requires careful consideration of the long-term financial impact. Now, whenever you're refinancing, it's going to be important that you determine your break-even point, because there are costs involved with refinancing. And determining the break-even point when refinancing your mortgage involves calculating how long it will take for the savings from the lower monthly payments to offset the costs associated with the refinance. So to do this, you first need to sum up all the costs of refinancing, which typically include application fees, appraisal fees, closing costs, and any other associated charges. Once you have the total cost of refinancing, you can compare it to the amount you will save each month from the lower interest rate or better loan terms offered by the new mortgage. To find a break-even point, you will divide the refinancing costs by the monthly savings. So for example, if the refinance costs amount to $3,000 and you save $150 per month with the new mortgage, you should divide $3,000 by $150 $150, they'll find that it would take 20 months to recoup the refinance expense. This break-even period indicates how long it will take before the financial benefits of refinancing outweigh the upfront costs. Understanding this timeline helps homeowners assess whether refinancing is a worthwhile investment based on their long-term plans and how long they plan to stay in their home. Now, some popular factors to consider when refinancing are the following. For one, the loan type. Fixed rate versus adjustable rate needs to be considered. Conventional versus FHA or VA. Your current home's equity needs to be considered. The importance of having enough equity is important for refinancing. Having equity will have an impact on the loan to value. Your credit score is going to play a big part as it helps determine the interest rate you're going to receive on that mortgage. You also want to discuss the option of rolling closing costs into the new loan. Now, here are the steps to start the refinance process. For one, you want to assess your financial goals. Assessing your personal goals before refinancing your mortgage is crucial because it ensures that the refinance aligns with your long-term financial objectives and current needs. Refinancing decisions should be driven by factors such as whether you aim to lower monthly payments, shorten the loan term, or access home equity for other purposes. Understanding your goals helps you choose the right type of refinance, whether it's to take advantage of lower interest rates, reduce debt, or fund major expenses. It ensures that the associated costs and benefits fit your financial situation. By aligning the refinance with your personal goals, you can make a more informed decision that enhances your financial stability and supports your broader life plans. Next, you want to check your credit and home value. Before refinancing your mortgage, it's essential to check your credit score and assess your home's value to ensure you qualify for the best possible terms. Start by reviewing your credit report from major credit bureaus to identify and address any inaccuracies or areas for improvement, as a higher credit score can lead to better interest rates and loan conditions. Next, obtain a current estimate of your home's value through professional appraisal or a comparative market analysis, possibly conducted by your realtor. Understanding your home's value helps you determine how much equity you have, which can impact your refinancing options and eligibility. By thoroughly evaluating both your credit and home value, you can make informed decisions and maximize the benefits of refinancing. Next, you want to compare lenders and offers. Shopping around for the best mortgage refinance rates and terms involves comparing offers from multiple lenders to find the most favorable deal for your financial situation. Start by obtaining quotes from a range of lenders, including banks, credit unions, and online mortgage brokers, and ensure you compare not just interest rates, but also other terms such as loan fees, closing costs, and the overall loan duration. Utilize online comparison tools and consult with mortgage advisors to get a comprehensive view of available options. Pay close attention to the annual percentage rate, or the APR, which includes both the interest rate and fees, as this provides a clear picture of total cost of the loan. By thoroughly researching and comparing offers, you can secure the most advantageous refinance terms and potentially save significantly over the life of your new mortgage. Next, you want to submit your application. The mortgage refinance application process involves several key steps to secure a new loan that replaces your existing mortgage. Initially, you'll need to complete a loan application form provided by the lender, which requires detailed personal and financial information. You'll be asked to provide essential documents, including pay stubs or proof of income, possibly tax returns, bank statements, and details of your current mortgage. Additionally, a credit report and property appraisal may be required to assess your creditworthiness and determine your home's value. The lender will review these documents to evaluate your eligibility for refinancing and to determine the terms of the new loan. Once approved, you'll receive a loan estimate that outlines the costs and conditions, followed by a closing process to finalize the refinance and disperse the new loan funds. If you made it to this point in the video, I imagine you're considering a mortgage refinance. If so, I highly recommend you follow the guidance I provided and connect with a mortgage professional to get the answers to any questions you have about your specific scenario. If you find this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages. And make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.